Well, hi, let's talk about the yen pairs, the dollar yen and the yen crosses. There have been a couple of questions about the yen pairs on my YouTube channel and on my Twitter. Actually, only a couple really, but I know there are going to be more because when I look at the sentiment, and I've got the MyFX book sentiment indicator, for what it's worth, these are retail traders. I don't know how many traders they represent, but probably quite a lot. Let's just have a look at what's going on, and this is quite a useful sentiment indicator. If you want to have a look at this, go and have a look at MyFX book and go to the sentiment indicator somewhere at the top here. There it is over there. And you can see how many people, not how many people, what you can see what percentage is long, what percentage is short, and by how much on or offside those positions on average are. So let's go across to the dollar yen to start with, the main pair. Remember, this makes up about, I think it's about 35 or 40% of the dollar index. So it's the second most important currency pair making up the dollar index. And you can see we've got 71% short positions and 29% long positions. Now the market's moving up, but the majority of retail traders are short. This is normal, and it's mostly the retail traders that get caught offside. Let's have a look at what the difference is between the longs and the shorts, and you can see, and I'm going to try and zoom it in and not hover this thing over here. I'll try and circle it in the video. In terms of short positions, the average short distance from the price currently is at about 564 pips. So on average, the short positions, that makes up 71% of the overall positions, are 564 pips offside, and the long positions are 73 pips onside. So very weighted to the downside in terms of positions, and also in terms of the amount of loss that traders are carrying. Obviously, there's going to be big concern, and obviously retail traders, many of you watching this are retail traders. In other words, you don't trade for a fund, you don't trade for a bank or a hedge fund or any of that sort of thing. So most people are offside. You can see it's just ticked up a wee bit now. When we look at the pound yen, about 400, it's difficult to see, it's very small without my glasses, or I don't actually wear glasses, 450 pips offside, and the longs are 200 pips in the positive. So slightly more balanced, but a lot more short positions, 85% short, so very heavily weighted to the short side. We can go through these one by one. When we get to the euro yen, you can see 86% of traders, retail traders, on MyFX book, and however they measure that, they represent a whole bunch of brokers and who trade through them, so I guess that's their information source. And those are about 496 pips offside on the short side, which is most of those traders, and 274 pips onside for those who are long, but it's a very small percentage of people that are long, only 14% long. Aussie yen, well, we've got 95% short. That's enormous. So really majority of traders short. I'm not surprised actually on the Australian dollar yen, because I think this one's got the best chance of being short, moving into the short side for a bunch of reasons related to economic conditions and interest rates and what's going on in terms of the Australian economy and so on. So I'm not surprised about that. And they're not too badly offside, only 200, I think that's 73 pips offside for those shorts, but majority, almost all the traders are short, and then 128 pips. Those who are on the long side are 128 in the positive. Then we go to CAD yen. Let's just have a look at a couple more. CAD yen about 90%, 89% short. So again, enormous amount, and 339 pips offside. So, and you can go through, I think that's basically all of it. There might be one or two more that I've missed, but that covers most of it. And you can see somewhere between 75 and 95% of traders are short across the board on these yen crosses, including the dollar yen, which is the second largest contributor to the dollar index. Not too bad actually. I've seen worse, but somewhere between 400-500 pips offside down to about 200 or 300 pips overall. So we've got the vast majority of traders on the short side, and we're somewhere between 200 and 500 pips offside across those currency pairs, depending on which pair you're looking at. So overall, there's a lot of pain in the market for people trading the yen pairs to the short side. In other words, buying yen and selling euro, dollar, CAD, Australian dollar, etc., and whatever else, the British pound and any other pairs being traded. That's why I'm getting questions about what's going on with the yen pairs. That's why there's a lot of interest in these generally, and it's quite interesting. I don't make very much money from YouTube, but I make a little bit. I haven't been paid a cent by YouTube yet because my postal address can't be verified because the postal system in South Africa doesn't work. But over about 12 months of putting up YouTube videos, I think I'm on about $800 or so, which I still haven't received. I'm not sure if I'll ever be able to verify my address. So I don't make these videos to create alarm and to make money. I'm not in the YouTube business, but I do get a lot more interest in videos when I address currencies, currency pairs or commodities. It could be gold, it could be oil or gas or currencies, whatever. People are trading and they're offside, and the stress levels rising, and people are struggling with those positions. So I do get a lot more interest, and that's why I think it's important to address these as well. Not because I want clicks, because I don't make any money from YouTube, not a penny so far. Although when I do get my $800, that will pay for some of my software, my charting, my TradingView charts and all that sort of thing. So that will be pretty cool if and when that happens one day. So having said all of that, let's look at the yen charts, and I'll go through a couple of them with you right now. So before we look at the charts, let's look at the Japanese interest rate, their central bank, Bank of Japan's lending rate. And there are some people that say, well, will it ever go above minus 0.1, which it is at the moment? And we can have a look at the chart going back, I don't know, into the 80s, 70s and 80s. And you can see since about 2015 or 2016, I'm not exactly sure when that was. You'll be able to see it down here, further down. But it dropped from 0% to minus 0.1, and it's been like that ever since. But if you look back beyond that, beyond 2010 to the left of the chart, you can see we've had interest rates going back into the 90s up to 6%, and before that even up to about 8 or 9%. So this ultra low interest rate hasn't been around forever. It's been around a long time, at least about 15 or 20 years, with a bit of a blip in the late 2000s there, but it's been like this for quite a long time. So what this means is that Japan is able to keep these rates as low as they are for as long as they want, it seems. And from their recent rhetoric, they don't seem to have any inclination to raise it. The reason I'm bringing up interest rates is because the interest rate is one of the primary drivers of the carry trade and the differential between currency rates between countries. A lot of it depends not only on economic factors, but also the interest rate. Countries with a higher interest rate generally tend to have a stronger currency. Now, there are all sorts of factors that affect that, of course, including economic factors such as economic growth and a whole variety of different measures. But the interest rate is one of the primary drivers of the currency rates and the currency differentials between countries. So we've been at negative 0.1% for a long time, probably 7 or 8 years. And the question is whether Japan is willing to increase their interest rate. There is one problem that they have, and that's inflation. And their inflation has become sticky, and it's possibly on the inflation is one thing that the Japanese really don't like. The Japanese consumer doesn't like inflation. The Japanese government doesn't like inflation. And there are historical reasons for that too. So the fact that inflation is becoming problematic in Japan, and it is, may influence their decision to raise interest rates. And there have been some murmurings and some suggestions that they might do that. So keep that in mind, bearing in mind that coming up on this Friday is the Bank of Japan's interest rate policy meeting, wherein they will announce their decision on interest rates going forward. So Friday is going to be a really key day for the dollar yen and the other yen crosses. Right, now we can go and have a look at the charts. So I'm going to look at the weekly chart for a couple of these yen pairs because I want to draw a broader brush picture here rather than going into the specifics and the intraday trading levels. I want to see from these longer term charts where we are overall and where we might expect the market to turn. I do think overall that the Bank of Japan doesn't want the dollar yen to rise much beyond where we are at the moment. When we got up into the 150s last year, when the dollar carry trade was at its sort of peak or zenith, there were a series of interventions by the Bank of Japan to drive this currency pair down. You can actually see it very clearly on the weekly chart. You can see there was one occasion there and another one and another one and another one. I'm not sure of the exact timing of those interventions, but they roughly coincided with these big bearish weekly candles. You can also see on every occasion the market attempted to rally in line with a carry trade idea and then fell back down with a new intervention. And it happened on each occasion. And now we've rallied back up into this sort of 140 zone. And I don't think that the Japanese government, the Bank of Japan, will want this currency pair to rally back into those very, very high levels we saw last year. If we look at the longer term picture, you can see how high we are in relation to the average sort of price of the dollar yen going back decades and decades. And it's normally around about the 115 to 125 region, more or less where this green line is. And that's where I think the Japanese would like this pair to trade. Not right up here at 140, which is incredibly high and expensive, even considering the highs that we saw last year. And assuming that there'll be more rhetoric about potentially supporting the yen against the dollar and the euro, Canadian dollar, Swiss franc, all that sort of thing, British pound, we're probably likely to see this currency stall out, somewhere around about where we are now. When the dollar yen stalls out and stops moving higher and begins to move lower, it tends to drag all the other yen pairs down with it. So if we see the dollar yen fall, we'll probably see the euro yen fall, the pound yen, the Swiss yen, the CAD yen, the Aussie dollar yen. We'll probably see them all fall at more or less the same time at different rates, depending on economic factors and interest rate differentials and so on, but generally all in the same direction. You can see as it's moving up right now, all those yen crosses are moving up simultaneously as well. We do have some levels above us, however, that we need to be cognizant of that we might have to reach up to. And first of all, we have a channel top here at around about 142.50, and that's a very neat channel drawn out by these two parallel lines that you can see going all the way back to the beginning of the year, starting off over here, moving up through there, and we've adhered to that channel top and we've adhered to the channel bottom all along the way. Just because we have a channel, it doesn't mean we're going to reach the top of the channel. At some stage, that channel will break and we'll fail to reach the top. That'll be called a channel failure, and we'll fail to reach the top of the channel and then eventually fall back down through the bottom of the channel. So what that means is that we may not have to reach up to 142, and we could stall out somewhere around about this resistance level here. We're somewhere near the 50% Fibonacci retracement and this green horizontal resistance line, just holding below there at the moment. And if we do manage to sort of stall here and turn around, we should see a test of this low here at around 138.50. I'll zoom this in using my fancy editing software and eventually see the price forcing itself against the channel bottom and then downwards through these levels here. Once we do that, we'll have to get through this thin red line, which is the 50 period moving average on the weekly chart, and this thin green line, which is the 20 period moving average on the weekly chart. So that's what I expect. I think it's worth trying small short positions here. And if this fails, we're going to have to allow for a move up to 142.50. And I don't think we're going to be able to easily get above there. In fact, I think it's very unlikely. Remember, we've got 3 big interest rate announcements coming up this week. Tomorrow is the US Fed interest rate announcement, where they're expected to hold interest rates as they are, even though it may be a hawkish hold. Then the following day, we've got the ECB and their interest rate announcement. They're expected to hike. And then on Friday, we've got the Bank of Japan, and they're expected to keep their rates at negative 0.1%. However, they may also insert somewhat of what you might call a hawkish tone and hint at potential intervention or future interest rate hikes. We'll have to wait and see. So that's the overall picture on the dollar yen. And remembering what I said about the dollar yen direction affecting the direction of all the other yen crosses, let's have a look at a couple of the other ones. So here we have the euro yen weekly chart. What's significant is that we've actually broken up above this high here at 150-ish, 150.20, which is the high going all the way back to 2014. So this is a really significant level. We've broken through it on one occasion, but then fell back down during that weekly breakout. We've now broken up almost back to the same level at around about 150, 150, but this week hasn't closed. In fact, it's the beginning of the week. It's only Tuesday today, and there's potential for this to fall back down during the week and not close above that red line. Remembering that red line is the high going back to 2014 over there. So that's a really significant level. We've tried to break up and close above it once. We failed. This is our second attempt. We've broken up above it for the second time, but this week still has 3 days to go after today. So we'll have to wait and see, considering that we've got those 3 interest rate announcements coming up and the statements that follow each one of those. It's very possible that the euro yen will break down back below this red line, this previous high from 2014, and form another spike and a double top at that level there right now. So once again, it's worth considering short positions on the euro yen, given all of the economic data that's coming out, considering that we're approaching a potential double top, looking at the incredibly overbought situation that we're in, and also considering that 2014 high that we have not managed to close above on a weekly basis yet. Actually, we did close above it about a month ago, but we fell back down below it the following week. So I was incorrect in saying that we did have a hold above that level, but then fell back down again. So that's my view on the euro yen. As long as we're below roughly 150, 150, and especially if we close beneath this red line at around about 150, that'll be a very good setup for short positions on the euro yen. For those wanting to get in early on a risky trade, but with tight stop losses and perhaps a small position to which you can add on a break and a close beneath 150, it might be a good idea. So that's the euro yen. Let's have a look at one more pair in detail, and then I'll skim through a couple of the other ones. Here's the CAD yen. You can see we've reached this channel line top. It's actually a rising wedge. So that's generally eventually a bearish pattern. It'll turn out to be a bearish pattern at some stage. This is not going to carry on going up forever. We're right at the top of that rising wedge. We've broken above this red resistance line over there, and that's really, it's kind of a rough line, and actually it's more of a zone. If I draw a rect then from sort of this area here up to there, you can see it's not really very well defined, and we're sort of in the middle of that zone right now. So once again on CAD yen, probably worth taking a small short position. And my approach to this has been to try small short positions, and I'm literally trading small positions, half my normal position size, and I'm using relatively tight stop losses, and I'm willing to try over and over again to take a few small paper cuts on these trades, looking for that eventual turnaround. And considering that I'm taking small positions on these trades, I'm willing to add to those positions if and when the price moves in my favor and breaks back down below key support levels, whereupon I can either exit my short trade, re-enter on a retracement to the underside of those support levels, and continue to move down. So that's CAD yen. Let's skim quickly through some of the other ones, because I know a lot of you will be looking at some of those other pairs as well. So I'll try and cover those very briefly. So here's the pound yen weekly chart, and you can see this is pretty overbought. This currency, however, is very volatile. It has large daily ranges, and it's often the reason why day traders like to trade the pound yen, or GJ as they like to call it. And you can see we're sort of prone to very, very large swings. So for example, this high over here in 2015 was at 195, and within a very short period we moved down to 125. Massive moves on this currency pair. So it's a risky one to kind of swing trade if you don't know what you're doing, and it can also be prone to very violent moves intraday. However, having said that, even though these moves are exaggerated, they will follow more or less in line with what the dollar yen is doing, as I said earlier. You can see here we've reached up into this resistance level as well. We're pretty overbought on this shorter term time frame over here. And if I put a rectangle in here as well from this red line up into this sort of messy zone slightly above it, like that, you can see we've just moved into that rectangular resistance area, right into the center of it, in fact. So I don't think this pair has the best odds for a short position. Not like the dollar yen or the CAD yen or the euro yen, the other ones we looked at earlier, but it'll probably follow in line with those. So keep an eye on the dollar yen and some of the other pairs to get an idea of what might happen on the pound yen. And if you're in doubt, just wait for a daily reversal candle, a clear indication that this currency pair is about to reverse. And apart from a couple of hanging man weekly candles, and if I zoom into the day chart, a couple of potential reversal candles over here, we haven't had very much to trade off. It's just edging its way up, and it's been very deceptive really, looking like it wants to reverse all the time, and then suddenly boom, today we get this massive move higher in line with the dollar yen. And you can see these big intraday moves can put traders offside very easily. This one here, for example, had a low of 166.5 and a high of 171.1. So 460, 500 pips in a single day. And in fact, today we moved from 174.50 up to 176.80. So 240 pips in a day. That's a pretty dramatic move. So probably not the best bet on the pound yen if you're looking to take short positions. Now, the pair that seems to be the most offside, remember the sentiment indicator that we looked at on my FX book, was the Aussie yen. And I understand why a lot of people are interested in shorting this pair. Let's switch to the weekly chart. This is a pair that we were very successful in shorting time and time again from early 2022 into early 2023, all throughout this period forming this crowning pattern, which eventually didn't complete. This is a crowning pattern which should have ended up back down here somewhere where the 200-week moving average is, but it stalled out here at around about the support level here. In fact, perfectly at that level over there. And then we've just bounced up from there. This inherently, I think, should be the weakest of the pairs. I think we've got economic numbers coming out of Australia, which seem to indicate that there should be more weakness in the Australian dollar. But we did get surprise interest rate hikes in Australia and in Canada, and that helped to push the Australian dollar up against the yen through this red resistance line up into the area where we are right now. Up above us, we've got the 78.6% Fibonacci, and that's at 96.4. We might have to reach all the way up to there. I'm not sure if we're going to get up to the top here. I think when the dollar yen stalls out, these should stall out at roughly the same time and begin to fall down. So we might have to get up to 96.4. We're at 94.5 right now. So potentially another 200 pips above us. That Fibonacci level at the 78.6% level is also the top of the sort of fronds of this crown formation. So it's a pretty key level, and that's at 96 call it 96.2 to 96.5, somewhere around there. Once again, I'm going to draw a rectangular box from where we are at the moment, this red line, up into these what I call fronds or spikes of the crown, and that's that pink zone that I've just drawn in. So you can see we've moved into it already. We're sort of into, not quite halfway, but almost halfway into this sort of frond area. My lights have just gone out, that's why my face might be a little dim. So let me just put on the brighter light. Right, now we're trading in the dark. That's South Africa. Lights go out every few hours. So we've moved into that pink resistance area, the top formed by the fronds and the bottom formed by this red resistance line at the bottom here, where the bodies of all of these candles more or less end. So we've moved right into that level, and I kind of think this is also worth having a go at small shorts, somewhere in this area, anywhere in this sort of pink box which forms this crowning frond zone. I don't know what else to call it. So that's the Australian dollar yen. So I hope that's given you a good overall picture of my feelings on the yen pairs, the reasons why I'm trading, what the sentiment is. An interesting fact about the retail sentiment is that often the retail traders are caught off sides, as you've seen from these figures that I showed you earlier. But eventually when these retail traders get more and more offside, and the average distance or the amount that they become offside becomes more and more extreme, the markets often turn around. So it's a sort of a contrarian but affirmative indicator at the same time. So when we start getting into these extreme levels of 400, 500, 600 pips offside, that's often when the market turns around, the point of maximum pain for the retail traders. And that's when a lot of them get stopped out, of course, and then the market turns once they've all lost their shirts, unfortunately. So when these retail traders get way offside, it's often no longer a contrarian indicator, but it becomes a confirmation indicator that you might eventually be in the right direction. Well, if you've enjoyed this video, please give it a thumbs up. And if you're new to the channel, why not consider subscribing? Take care. Have a great trading day.